Hello, I'm Brian and welcome to this video which will be about the ACCA paper P5 March and June 2017 revision guidance. Now for this video you will need a copy of the question and answer set which you'll be able to download from ACCA Global. Now in this video we will be approaching the question using a 5-step approach which can apply to any P-level paper in the ACCA examinations. This approach, the first step will be to assess the question. That means you're going to read the question and see exactly what the question is looking for. You're going to find relevant data in the question scenario. You'll be evaluating that data for suitability, whether it's useful or not to you. You'll be drawing from your knowledge which you have studied and trying to evaluate that data and think how do you answer the question. And finally, step 5, you will answer the requirements of the question. Now this is very important so that you don't write out of point. We will now be looking at question 1, part 2. Assess the assumptions and definitions used in the calculation of the current set of key performance indicators in Appendix 1. Now, if you're looking for other parts of this question, take a look at the cards which you will see at the top part of the video, and you can either go back to the earlier part or go to a later part if it's available. So, first of all, we will be assessing the question. Now, assess the assumptions and definitions used in the calculation of the current set of key performance indicators in Appendix 1. Now, first of all, whenever we see a question, we will want to look at the verb which they use. Now in this case, the verb which they've used is the word assess. Now this is different from many of the other verbs. Now when we talk about assess, means we're looking at something which is already available in the question. And it involves a certain amount of judgment. Is it good? Is it bad? Is it relevant? Is it reliable? It's slightly different from evaluate because assess has an element of judgment here. The second part of the question is we're going to look at assumptions and definitions. Now when these assumptions and definitions apply, this is a data object. That means we are going to be searching for this inside the question scenario. So now that we know what the question looks like, we're going to move on to our next step. The next step would be to find relevant data. A lot of students have issues with reading the thing and reading the question prompt and looking for what is relevant. Now, one thing important to remember about even at the P-level papers is that they don't give you a lot of junk. They will give you things which are relevant. So every sentence is important. It's there for a reason. So now we're going to look at the question again, and the data which we're looking for is assumptions and definitions. So the first part would bring us to the KPI definition and notes. They will find this at the back of Appendix 1. Okay, so they have 8 different notes over there. And you will also have the current set of key performance indicators. They've told you it's in Appendix 1. And if you've seen my earlier video, we are looking at the same 6 sets of KPIs over here. Operating profit margin, secured revenue, and so on and so forth. There is also some additional guidance which is provided to you in paragraph 4 of the question. Now I want you to bring your attention to the second thing that your question prompt is talking about. So we're going to start here. Second, taking each of the current indicators in turn, she wants the assumptions underlying the calculation of the indicators examined. There's been a suggestion made in the press that DS is producing, now this is important, a biased set of results aimed to mislead the markets. This would then artificially boost the share price and so boost the value of senior management's shareholdings. So this is a part of the question which guides you on why is this person so concerned about the KPI. It's because it produces a biased set of results which artificially boosts the share price. It means the performance is overstated or inflated. And we're going to keep that in mind as we go on to the next part of the question. The next step would be to evaluate the data which is available to you in the question. So we're going to go back to the notes. We're going to go by each KPI in turn, so you know exactly what's going to happen. So the KPIs are here. There are 6 of them. Let's start with operating profit margin. Now, operating profit margin is a very standard performance measure. You should have come across it before in your ACCA exams. And the note which is relevant to it is note 6. Now, if you look carefully at note 6, they say here this excludes exceptional items. So why is it excluded? When P5 gives you a certain amount of data, you need to take a look, why is it excluded? So that's a question that we need to answer when we answer the question. It seems like that's quite a lot of money, $55 million. So we'll deal with it when we answer the question. The second one is secured revenue. Secured revenue is basically contracted versus budgeted revenue, and it's relevant to note 3. Secured revenue is long-term recurring revenue. So it's already explained to you how to calculate it. One of the key issues here is that it indicates the reliability of a revenue stream. That means in the future, if your secure revenue is quite high, it means that your revenue is going to come in quite consistently and is quite safe. Now, the second line has something very important. The budget is often not completed until well into the year, as it is a complex process. Now, most of the time, a budget is completed before the year. If you're using a yearly budgeting example, we're going to make the assumption here that it's going to be beginning of the year, but in this case, it's not completed until well into the year. So this is something we need to pay attention to when we answer the question. At the third line, the original budget is 1565 million and the signed off budget is 1460 million. That's quite a big difference. So now that we know what to look out for, we can answer the question. Management retention is about full-time managers. That means you keep managers in your company. Usually that's a good thing. That means your employees are happy to stay with you and things like that. But one key element that we're going to pay attention to is note 4 over here. This figure only includes employees on full-time contracts, which is 65% of all managers. Where's the remaining 35%? So a significant number of part-time managers is not included, meaning they are totally ignored, which makes you think that this measure is probably not very reliable. We're going to take a look at the fourth one, which is order book, which is a potential future revenue stream. You're going to get revenue from your order book. And something interesting here is that they have calculated order book using total cash value, which is okay. A lot of companies do report using their cash value. But in this particular scenario, DS has contracts which run up to 10 years into the future. 10 years is a very long time. So what does this mean? This means that a measure of the future revenue of cash value, it does not take into account the time value of money. You should be familiar with the term time value of money. Basically, it means that cash received further in the future is worth less in today's money. So 10 years is quite far. We have to keep that in mind as we answer the question. Fifth one is organic revenue growth. This is a historical measure. It's basically just saying what was last year's revenue compared to this year's revenue from existing operations. So this is relevant to note 7. Organic revenue growth is calculated using the total revenue figure. So let's draw our attention to the second part of the note, which is over here. It includes net acquisitions. So if you have done your studying in paper P5, you will realize that net acquisitions is actually inorganic growth. It means you've bought a company and taken over their revenue stream. So usually we would not want to include such revenue in our organic growth measure. Finally, we have ROCE, which is a pretty standard, commonly used performance measure. It measures the efficiency of generating profit from your capital base. And this is relevant to note 8. They've given you the formula. Capital employed is the total assets less current liabilities. It's a very standard formula, but we have to pay attention to something. It is based on tangible assets, and DS is a service company. Service companies probably won't have much tangible assets or things that they don't have buildings. They don't need a building. They will spend a lot of money probably on employees, a lot of HR expenses, and there will also maybe a lot of consumables. And if you look carefully at DS does a variety of services like catering and cleaning. These don't really need a lot of capital to run. So we need to be careful about the relevance of the ROCE performance measure. So now we've done step 3, we've evaluated the data which is available to us. We now need to start thinking about applying our knowledge on how to answer the question. Okay, so now we are in step 4 of our 5-step question approach process, which is drawing from our knowledge. That means based on what we have studied, we're going to answer the question and start thinking about it. So there are 6 performance measures here, and we're going to take a look at the first one, which is operating profit margin. I'm going to split my thought process, or our thought process in this question, to 2 things. First of all, we need to see how the investor, which is the user of this performance dashboard, look at these 6 measures and make their decision. And second thing, we're going to look at potential manipulations or maybe assumptions related to the performance measure, which might mislead the investors. So let's take a look at operating profit margin. As far as investors are concerned, the first thing that they use it for is to examine general profitability. Operating profit margin is a very standard performance measure. All companies use it and is, well, accepted by most investors. And in this case, very simple interpretation, higher profit margin in percentage means greater profitability of operations, more efficient operations in generating profit. The potential manipulation is here. The classification of certain operational costs is excluded. In this case, they have excluded some reorganizing costs of the catering department. If they have excluded it, the profit margin decreases to 2.3%, which is quite a lot. There's quite a lot of a decrease in the reported profit margin, and if they had included this cost. And third thing is that it's a material change in the nature of the reporting. The catering business from profit will now move to loss, and that's a big deal. So when we answer the question, we will want to talk about these things. Secured revenue is the second KPI. And how would an investor use secured revenue? It basically tells them, look, this revenue is consistent or not consistent, and it's a very easy interpretation as well. Higher secured revenue means a more consistent future revenue stream. So where is the potential manipulation? We are going to take a close look at the budget. Secured revenue is calculated by taking a budgeted total revenue versus the actual secured revenue. That means revenue from contract. Now in this case, the budget may be adjusted during the year. If you have read the notes properly, they said that the budget was only signed off by the end of Q1. That's 3 months into the year. So probably they have looked at the budget. Oh no, we have set the budget too high, and then the secured revenue margin is not going to be so nice. We're going to reduce our budget so that it looks better. So the budget was adjusted 7% lower than original, and I've added some calculations over here. The adjusted budget was 5% lower than actual. This is just some observations. Secured revenue is 82% of the original and 83% of the actual. I think and compared to what was reported, which is about 88%, that is quite a lot difference. We're going to talk about this when we answer the question. Next one is management retention. Management retention is used by investors to examine the talent retention of DS. That means you keep your employees. Now, usually, if you manage to keep your employees long term, that's a good thing. It reduces your recruitment costs and things like that. Higher percentage means you keep your talent. Basically, that's what it means. So investors would like to see management levels with a low turnover rather than a high turnover. Now, this is potentially manipulated because the measure excludes certain employee groups such as part-time managers. They did say that they only include full-time managers in the notes. Now, 35% of all managers are excluded, and that's a material number. That means these managers are ignored as far as this KPI is concerned. So there is potential for the measure to be consistently and significantly much lower. The fourth item we're going to look at is the order book. How would an investor approach an order book? The investor will approach an order book by looking at the consistency, again, of future revenue streams. So if your order book is quite big, that gives investors a certain amount of revenue security. Higher percentage, higher dollar amount means larger consistent revenues in the future. The potential manipulation here is that they have reported the order book in cash, on a cash basis. They did not take into account the time value of money. Now, if the contracts that they've signed with their customers is short term, maybe 1 or 2 years, then it's not that big a deal. But the question specifically mentions that some contracts are up to 10 years. So you do have material uncertainties, and this could lead to the cash value, which was used in the KPI, significantly higher than the net present value. So we're looking at the fifth measure, which is organic revenue growth. Now, the word they use, organic, means that you're looking at revenue from existing operations. That means we are not creating new branches, or we are not buying a new company and taking over their revenue streams. We are only looking at our existing operations. So it is a revenue measure, and we find that in this particular performance dashboard, there are quite a lot of measures which talk about revenue. You have secured revenue, you have order book, you have organic revenue growth. And in this case, we are looking at a higher percentage. That means an investor would want to see a consistent high percentage. It means the company is growing very fast as far as revenue is concerned. Now, the potential manipulation is that the measure has included some inorganic revenue growth, meaning that they have purchased some organization, some other firm, so it's an acquisition, and they've included it in the organic revenue growth measure. So what happens is it leads to an inflation of the measure. That means the measure is more than it should have been. The calculation is over here. If excluded, the revenue growth drops to 3.9%. 3.9% is much lower than the 7.2% over here. So now we're looking at the last KPI in our list, which is ROCE. And ROCE is a pretty standard performance measure. Investors use it to look at the efficiency of an organization's capital base. So the higher percentage means you're using your assets very well, you're generating a lot of profit from your assets. Now, where's the manipulation here? The thing is, we need to keep in mind that DS is a service-oriented company. So it does not have much need for tangible non-current assets. You don't need a giant building, you don't need a factory, you're providing services, you don't need all that. So your capital base is going to be small compared to maybe a manufacturing company. It's going to be small. And second thing is that you exclude, because it's SOFP, and SOFP follows financial reporting standards, and you're probably going to exclude a lot of intangible assets which DS probably is using to generate profit, because they fail to satisfy financial reporting rules. So based on that, what might happen is that ROCE may not be as relevant as the performance dashboard says it is, because it is a service-oriented organization. It might not be relevant enough. Okay, so now we are done with step 4, and we've got our thoughts together. We're going to start writing the question. So step 5 is answering the requirements. You're going to write the question. Now, the way I frame this, I'm going to give you some quick tips first, and then I'm going to give you a skeleton which you can write if you don't have enough time, and then of course the full answer in a way that I would write it. Now, the quick tips are, first of all, since we have 6 different performance measures, we are going to write each performance measure on a separate paragraph. Number 2, we are going to talk about the usefulness of such a measure to investors, because the requirement does talk about the assumptions and definitions and stuff like that. And third of all, we're going to analyze very quickly, or in the terms of the question, assess the assumptions and definitions used by each measure. So here is the skeleton writing for the first KPI, operating profit margin. You can write this. You will earn some marks, passable marks. In case you don't have enough time or you don't really know what to write, you can probably write something in this form. First of all, operating profit measures efficiency from profit for operations. Second, higher percentage means more efficiency. So this is a general interpretation of operating profit margin by investor. Third, there is a potential misclassification of costs which inflate the measure. Okay, now the next one you have is I'm going to show you the written one. That means I'm going to write a full answer. If you write this, you probably would score full marks. So just more words. Operating profit is a standard performance measure used to evaluate the efficiency of generating profit from operations. Number two, in DS case, the main issue is the potential misclassification of the exceptional costs, which inflate this measure. If the exceptional cost was included in the measure, profit would drop to 36 million, resulting in a 2.3% profit margin. It's much lower than 5.9%. So these are the details which, if you don't have time, you probably don't have time to write it out or calculate it. But if you do, it's good to show the examiner that you know what you're talking about. You can analyze the data given in the question prompt. I'm going to give you another one. The catering business would now report a loss. Very important to highlight that, a loss of 39 million. So a profit has become a loss, and that is quite material. Our next KPI is secured revenue. I'm going to show you the skeleton answer first. First of all, proportion of revenue earned from secured contracts. Higher percentage means more consistency in revenue streams for the future. The potential manipulation is the budget, which they do somewhere in the middle of the year. So it inflates the figure. They can reduce the budget. The full written answer would probably look like this. Secured revenue is a performance measure that would indicate to investors the consistency of revenue streams from committed contracts. Higher measure means more consistent revenue than budgeted. Now in this case, the main issue is the manipulation of budgeted revenue. You can't manipulate actual, so you have to manipulate the budgeted one if you want to inflate the measure. So I've given a table here. It's okay to use the tables in your answers. I know the answer is asking for report format, so you probably want to put a table and write there figure 1 or something like that. So here I've included a table, and you can clearly see there's a significant difference between the original budget over here and the one that they have included in their performance dashboard. That is a 6%, slightly less than 6% drop, which is quite a lot. If we're talking about the multi-billion-dollar company, that's a lot of money over there, right? Now, if we go on, it shows from the table above that using the original budget would result in a significant reduction in the secured revenue percentage. Something interesting to point out, you might not need to write this, is that the actual budget is much closer to the original budget than the revised one. That means the revised one is severely understated. Now we're going to talk about management retention, and we're going to show you the skeleton. First of all, is a proportion of full-time managers retained. Higher percentage means retention of talent. The manipulation is that they exclude part-time managers, which is a material number. The full answer would probably look like this. Management retention indicates a percentage of full-time managers retained. Higher percentage would be retention of talent. So you realize that I'm just expanding my skeleton. There is not much calculation here because we are not told what is this part-time contracts data. So we just talk about it. Exclusion of the part-time contract is the main issue, and because these people are excluded, it might indicate inflation of the measure, because part-time people probably they quit or resign or take a break a lot more than full-time managers, and this will bring down their retention rate. So now we are on order book, and the skeleton answer is very quick. Future revenue earned from committed contracts. Higher dollar indicates larger future revenue. Time value of money is ignored. So, and because some contracts are very long term, this is a big deal. The full answer will probably look something like this. Order, okay, so the first two lines is the same thing as a skeleton. I'm just putting it in a proper English sentence. Indicates the potential future revenue streams. A higher measure would indicate more consistency in future revenue streams. And in this case, the fact that time value of money has been ignored is the main issue. The difference might be significant, as some contracts may be as long as 10 years. So this was stated in the notes. You copy paste the notes into your answer and then analyze it from there. So you realize that by now, the first two sentences in every one of my written answers, or even the skeleton, is based on what we know, our knowledge of the performance measure, which we can draw from our own knowledge or even the question prompt. And then the second two sentences would be our analysis. Now we're going to look at organic revenue growth. The skeleton is, again, very short. You can write this if you don't have time. Historical comparison of current revenue to past periods. Higher percentage means more growth in revenue. That's a good thing. But in this case, they have included inorganic revenue growth. So that's the problem. The answer would be more fleshed out because we have time to do the calculations. So the order book indicates historical growth on revenue. Higher measure means current operations are growing in revenue. In DS case, the inclusion of inorganic revenue growth may have inflated the measure. And I've included a calculation over here. If the acquired revenue streams were excluded, the measure would be 3.9%, which is much lower than 7.2. That's 3.3% difference. That's quite a lot of a drop as far as growth is concerned. Now, the last KPI we're going to talk about is ROCE. So I'm going to show you the skeleton answer again. Efficiency of generating profit from capital base. This is a standard definition. Higher percentage means more profitable. Capital base, you're using your assets efficiently. So DS is a service company, may not have such a big capital base. It's not good to compare it to maybe a manufacturing company. ROCE may be irrelevant. The fourth point is the calculating of ROCE from SOFP may exclude significant intangible assets. This might include research and development, which does not satisfy financial reporting standards, or it might be branding, which also, or other types of intangible assets or goodwill that just fail to be recognized by the SOFP. So the full answer, I'll write out something like this. ROCE indicates the efficiency. Second one, a higher measure that the organization is using its capital base more efficiently. Just different ways of saying the same thing. And in this case, because DS is a service organization, it does not need a large tangible asset base. And finally, because you are using SOFP, it excludes significant intangible assets which might fail to be in SOFP because they don't satisfy financial reporting criteria. Okay, so that's the end of question 1 part 2. I hope this helps you. Please take a look and comment or like. And if you want more about certain subjects, please add a comment and I will try my best to create another video for you to take a look at. Thank you very much. Bye bye.